Good afternoon, everybody. Welcome to Topstep's Back to School webinar. Today's webinar, we're going to be discussing risk management. Dan, you with me?
I'm here, John. How you doing today?
I'm doing good. Having a busy day, FOMC day today. Kind of a,
Market's moving pretty good there, huh?
yeah, kind of a non-event at first, but we see our equities heading back down below that 3380 level of yours right now. Interesting
Uh,
stuff.
Gotta love the run down to 80. It's been a nice little opportunity here the last few weeks.
Well, all right. Well, let's get started. As always, we're going to introduce ourselves. I'll start. I may have to get a new joke about this, Dan, but my name is John Hoagland, the senior performance coach here at Topstep. I much prefer um, middle-aged performance coach,
There
perhaps.
it is.
But if the shoe fits, I guess we'll wear it. More than 38 years of futures industry experience, not all of them necessarily trading, well over 25 years of that. I traded on the floor of the Chicago Mercantile Exchange and a little bit on the board of trade for a couple of years, actually the Mid-America Commodity Exchange. My dad was on the trading floor for 45 years. I guess that's where I got the bug for it. In 2009, as the opportunities on the trading floor started to really push towards the electronic trading, I stepped out of the pit, started to learn how to trade on screen. Met the folks here at Topstep, Michael Patak, Eddie Horn, and Melissa Footlick were the only ones here at the time. Found out what they were doing, really just fell in love with it. We weren't going to have the opportunities that we had back in the day to learn the business in a safe environment by just getting a job as a runner and working our way up. I thought that Top Step was a wonderful idea to get people anywhere, any place, pretty much give them the opportunity to learn in a safe environment and then to get funding. So since about 2011, it has been a great pleasure that I have enjoyed to be here and to be helping traders improve their performance. And I hope I've done that for as many people as I can, something I really enjoy. Dan, who are you?
Oh, well, my name's Dan Hodgman. I too am one of the performance coaches here at Topstep. Just like John, I grew up in the industry. My dad spent little over 30 years trading. He owned himself a few different prop firms that I actually traded for two of them. And I got into this when I was in high school. I started kind of catching the bug. As a kid, I used to want to hang out with my dad and his brothers and watch football at family parties. And the only way to do that was to start learning the lingo. And so I started writing things down as a little kid to come home and ask my dad and say, Dad, what's a spread? What's the straddle? What's a strangle? What are these things? And he used to think I was crazy asking these questions. And as I got a little bit older, every little bit of free time I had, I spent down on the floor clerking and running, checking trades. And when I was about 18 or 19 years old, he looked at me and said, let's take the chance. Let's teach you how to do this." And so I began um, hedging options. So I hedged for him and about three or four other traders between the 10 and 30-year option pit at the Chicago Board of Trade before I started arbing against the pit a little bit. And then from there, I started trading for myself. I've been managing my own futures account since I was about 20 years old. And then I went and served in the United States Marine Corps for 4 years, while also maintaining that futures account. Once I got out of the Marine Corps, I came back to trading. I was going to go to school, try and get the normal corporate job. But after about a week after getting out of the Marine Corps, I called the old man up. I said, I'm going to come down to the floor for a little bit and I'll do some hedging for you guys. I'll start covering your positions a little bit. And next thing you know, I got roped into moving into the office. So I got moved off the floor. I went up to the office. I started trading treasury spreads, yield spreads there against the cash. And then I got in touch with Michael. Michael invited me over here to Topstep, and I was in the process of taking a little break from trading. And I figured, why not? And I thought I'd be here for a little bit. And now going on almost 4 years, I think Topstep's a great program. I love the concept of it, and I love working with all the traders here.
Dan, be honest. It's because I'm here that you're still here, isn't it?
Exactly. John keeps me here, keeps me sane.
Uh, I hope Bonal Lucas is able to hear. I'm hoping everybody can hear. Let us know if you're having trouble hearing us. Apparently, a level 2 is hearing us talking about that 3380 magic level. Well, why don't we go ahead and jump into this, Dan? One of the most important things in futures trading and investing and in life in general is learning how to keep your money. I always have these dad wisdoms. That's a picture of my dad on the floor of the Chicago Board of Trade. He was a hedge manager for Ralston Purina for many years, as well as an individual trader. And you see those check cereals boxes. They were handing out boxes of check cereals that day. The other person in that picture that's cut off is the president of the Chicago Board of Trade at that time. But he had lots of great wisdoms, and most of them were usually funny, but usually with a very serious tone to them. And this particular wisdom, I think, really fits today. Is money is it's easy to make, it's easy to lose. All we have to do is, grab a dome and buy or sell something. So it's really not that hard to do. Easy to make, easy to lose, very difficult to keep, and that's what we're talking about today. Is risk management.
John, it's great that you bring that up. I think you think about it across the board. I love the idea of the dad wisdom here. One my dad always told me, and I think this is true with really any successful trader out there. My dad used to always tell me, you can never let one trade make or break you as a trader. And I think that's the same concept here. It's easy to make and lose, but one of them cannot be the reason you are where you're at today. And that kind of falls into that risk management mindset.
Yeah, sure. And I think I actually meant to put a different wisdom on here, but I'll just mention it. He always used to tell me, I could double my income if I would only trade 3 days a week. And I'd say, well, why don't you just trade 3 days a week? And he'd say, well, I don't know which days to take off.
Right.
It's all part of the game. It's two steps forward, two steps forward, one step back.
Without a doubt.
All right. So risk management, I figured it'd probably be a good idea for us to define what risk management is. And in business, this is right out of the dictionary. In business, it's the forecasting and evaluation of financial risks together with the identification of procedures to avoid or minimize their impact. We always want to minimize our risk. In trading, and this one is written by me, it's still a noun. In trading, it's the ability to hypothesize good trade location in order to minimize risk. Where there is a cheap trade with regards to risk, where does price have to go to prove a trade invalid? We want to take our trades as close to those levels as possible. So let's look at some of the features of risk management. I thought this was a very apropos picture. The guy looking over the cliff. You would never see me do this. I would be dizzy and I would fall probably because I'm not real big with heights. Matter of fact, just looking at this is making my palms sweat. So let's move on from that. One of the things that I don't think most people recognize is risk management is rarely a natural or something that we are wired to do automatically. Nobody likes losses. Avoidance of losses generally tends to create bigger losses. Think about it, all of you, if when you've put your first trade on, if that trade was a loss, you probably defaulted to, I'm just going to wait. I'm going to wait. I'll bet you the market will come back and make me whole again. And it's not going to take very long for you to figure out that avoiding taking that loss only creates bigger losses. On the flip side of that, winning trades feel so good that we just want to take them quickly, especially after suffering a little bit of loss. Professional traders know the risk they are going to take on any trade before they take the trade, and they are quick to cut losses. They also understand the size of the possible profit, reasonable and probable profit targets greater than 2 to 1 over the risk that we have to take on the trade can keep us in the game for a long time. We're talking about risk management. We're also talking about reward over risk. Retail non-professional traders trade to 1 to 1, even 1 to 2 reward under risk. Professional traders are always looking to increase their profits by multiples of the risk that they are taking on the trades. I remember when I got my mid-am seat and I walked on the floor with my dad, who was at the Board of Trade, and walked around and talked to all his buddies that I already knew for many years. And they'd say, "Hey, great, you're going to the mid-am. Awesome. Go get in there and make sure you learn how to take a loss." And in my youthful exuberance, I remember thinking, why would they be telling me that? Dan, why would they be telling me that?
You know, I had the same thought. Why would they tell you that? But you know what? It's really important. Losses are the hardest thing to accept in trading. The wins are pretty easy. It feels like you have here. It feels really, really good to take that win. And when the market goes against you and you have to feel the heat, it gets really hard. And the quicker you can get used to taking that small loss, the better opportunity you're going to have overall.
100%. You got all these old pros up there telling you, hey, learn how to take a loss. How many losses do you suppose they've taken? A lot.
I would say more than we can count.
So one of the things we want to first think about when we're talking about risk management is having a solid overall trading plan. If you don't have a plan for your trades, it's going to be very difficult for your overall trading. It's going to be very difficult for you to even locate areas where you may find a better reward than risk. If you don't have a trading plan, you have no guide points, you have no plan, you have no way to determine what you're going to be looking for, who you are as a trader, what's your time frame. We're all day traders here, so we're kind of talking mainly about day trading. But in day trading, you can be a scalper, you can be a little bit longer time frame. You can be what we call a day time frame swing trader, where you're looking to take some really big bites out of the day time frame moves. But if you don't have a plan for recognition of that, you're going to be really just kind of flying by the seat of your pants. And that, to me, is one of the biggest risks that any trader can put themselves in, is just not having a plan. Dan, what do you think?
John, I could not agree more with what you got here. The plan is the most important thing. And I will say, I think people overestimate having what that plan is. It can be very simple. I'm coming in today. I'm going to focus on entering at key levels I've been preparing for. The risk that I'm going to take will always be minimum 50% of what or maximum of what my reward is. And if you can keep it very simple and stay consistent each and every day when you come into the markets, that right there is a plan. And if you can stick to that plan, I think one of the things I've heard a lot when it comes to this stuff is, well, I have to find my edge, and consistency and sticking to your plan can be a major edge.
Yeah, there's lots of different edges in electronic trading. In the pit, it was basically the edge was buy the bid, sell the offer, buy the bid, sell the offer. So I think what Dan's talking about is, you don't have to have a extremely complicated overall trading plan. As a matter of fact, your trading plan can change from time to time or from day to day according to the market state. When you have a trading plan, part of that trading plan should be to hypothesize possible opportunities for the following day or for the current session. You should have a plan for each aspect for every aspect of each trade, if the hypothesis you have, your main hypothesis, begins to come true, you should already have an idea of how you want to handle that trade. That's kind of what I'm talking about by saying you should plan for every aspect of each trade. If this hypothesis begins to come true, what is the strategy I'm going to apply to that hypothesis? If it's a breakout to the upside, I'm going to look for the upside. I'm going to get in as the breakout occurs. I'm going to only risk so much. And if the trade goes in my direction, I'm going to have reasonable and probable profit targets, barring the fact that it may turn into a trend. One of the things that I like to look for in risk management is to find confluence in different time frames or different indicators or tools. Those of you that know me know that I like the market profile, but I also use the market profile in conjunction with longer time frame charts for a bigger picture, but I'm also using the 30-minute chart. So if I'm nearing an extreme in the 30-minute chart and the profiles are telling me to buy weakness, I'm going to try and buy as close to that extreme of that profile as I can, because I'm seeing confluence in different time frames, in different time frames and or different indicators or tools. That makes sense, Dan? Does that make sense?
Yes, it sure does, John. And I just wanted to throw one thing in here on top of that. Just going back, having the plan for every aspect of each and every trade. I can't even begin to describe how important that is. Every trade that you get into, you have to know where you're going to get in and where you're going to get out. I think a lot of people get into trades with this expectation that this is the one. This is where I'm going to knock it out of the park. And we cannot plan for that. That's not part of the plan. Once we kind of set ourselves up to be able to take advantage of that, absolutely, every so often we might be able to catch that runner that really starts to go. But when we enter that trade, it's knowing, where am I going to get out? Where am I going to take my profit, or where am I going to take my loss? I can sit here and the reason it sits heavy with me is I took some shorts earlier today in the equities and I ran them down to settlement price, and I was getting out because I just had a hard time seeing this thing really go through settlement price, especially prior to the FOMC.
FOMC.
And don't get me wrong, did I want to take a run all the way down? Without a doubt, everybody knows how much I love that 80 level, but my plan said otherwise. And I got out when we got closer to settlement price, and that was good enough for me.
So you had some pretty decent reward over risk on that trade. Are you sad that you missed out on some of that move continuation to the downside?
Well, as sitting here in the shoes that I'm in, I should say absolutely not. I'm very proud that I stuck to my plan, but I mean, yeah, just like anyone, I'm bummed out. I missed on some pretty good money, but I cannot plan for that. This market told me all day today it was staying inside. To expect that final breakout, I cannot expect that. The number
Mhm.
wasn't as volatile as some have been in the past, so I was
Mhm.
not going to sit here with that expectation, and I stuck to the plan because that's what the plan said.
I'm proud of you.
Thank you.
I'm proud of you. Uh, the One of the things in performance coaching that Dan and I both see is when traders get good at finding good trade locations. Traders start to get really good at finding areas where points of invalidation are very close to the current price. And so once they get to that level and they start recognizing that, hey, you know what, I'm pretty good at finding good trade locations now, the market starts going their way with a little bit more frequency. And what happens is they end up getting dollar signs in their eyes. Maybe they had a good big winner one day, and they start to think that every winner is, every time they get a good trade on, it's going to be that size of winner. And market size and opportunity does change. It's a dynamic as the markets are. But that's why I'm proud of Dan, because he had a plan for the trade and he stuck to his plan. Doesn't really matter what happens afterwards. And this next bullet point here is kind of along that line. It's focusing on risk management is what's most important. Just looking for trades that are close to points of invalidation can put you in the driver's seat when the market is going your way. You know, Dan had the opportunity to adjust on the fly if he thought the market was going to continue and get down to his 3380 level today. He stuck with his plan for whatever reason. Perhaps it was because it was FOMC day today. He said, I'm sticking with that plan. I'm not seeing anything that's telling me that this market may continue down to that level. So I'm taking it out. A wise man once told me, we don't get any smarter once we put the trade on. However, we also want to stay flexible and reasonably and reasonable to accept information that may be telling us something else is going on here. Risk management is most important. The second part of this, profits take care of themselves. Yeah, sometimes they will. If you get into a trending market, you don't know how far that trend is going to go on that given day. Trending days, I agree. Profits can take care of themselves. Today was not a trending day. Dan, you did the right thing.
Thanks, John.
That goes right to the next bullet point: is set stops and profit targets for each trade. 90% of the time when I get into a trade, I'm setting my stop at a point of invalidation and I'm setting a profit target reasonable and probable for the current market state, at least twice the risk I have on the trade, period. I don't even think about taking a trade without the idea that I may earn twice on this trade what I risk to get into it.
Without a doubt, every trade, as soon as I think a lot of people know, I'm a big levels guy. I love looking at the market as it approaches certain levels, and some levels may come into play, and I don't have an option because if I'm looking at everything, my stop would, if I took that trade, the stop would be way too far out there for the reward that is possible within that trade. And there are times we may think it's a pivotal level. Maybe that market was approaching that 3380, but I did not see anything close enough to establish a legitimate stop. Therefore, that trade for me would be invalid because the profits would not be there to return the reward.
Now, here's a question. You see an opportunity, but the risk is too great. The reward might be 1-to-1 at that level. But what if we were to place a stop to get us closer to the point of invalidation on that trade to even out our reward over risk to 2-to-1? Maybe we're going to get that chance. Maybe we're going to see that market get a little bit closer to that point of invalidation, giving us that 2-to-1 reward over risk.
Absolutely. That's one of the biggest things that we look for. These levels, I think, John, you say it very well. These levels are not finite, they're areas. So we look, we see the market approach, we watch how that market reacts. And if it gets to a point where we can manage that risk and we have good risk to reward ratio, then we can consider that execution.
So it's still a factor of managing risk first.
I think that has to be our first focus in this. I think a lot of people get into this industry because they want to be traders, but I truly believe we are not necessarily traders this day and age. I think we are risk managers. If we can, and money managers, our job is to grow that account. And if we're taking too much risk, we're risking losing that account. We're not managing this properly. We cannot just trade to trade because the more we trade, the more risk we are putting on. If we are not managing that risk, we're over time going to lose that account.
And just like Dan did today, you stuck to your plan. Were you emotional getting out? Was there any trepidation in your exit? Were you thinking maybe this thing will keep going?
Yes, I definitely watched it for a little bit and thought about letting the thing go. And I thought to myself, well, you know what? If I sit in this thing and let it go, it's going to turn around on me, go against me. And if
Always
I
seems to
close,
happen
and
that way.
as soon as I close this trade out, it's going to break. It broke as soon as I closed my trade out,
Next time you do that, tell me you're getting out of it so I can get short.
right? Well, it's like we always say sometimes if you're trying to get the market to go in your favor, feed it a little bit.
Yeah.
And you got to give one to the market every so often to feed it to your direction.
If you had multiples on, all you had to do was buy one, and that would have been enough. Market
Thought
would have
about
the market would have thought you were long.
it.
So, but even in that face of that emotion, you looked at it, and you said, I'm going to stick with the plan. Good job.
With, without a doubt. That plan's there for a reason. I've always said as soon as you get into that trade, you become biased just about everything. You make those sound decisions before you have that position on. Once that position on is on, you start to focus on the dollars. And that's when we start to struggle. That's when we make poor decisions. And that's when we just have to step away and say enough's enough.
Back to we don't get any smarter after the trade is on.
Absolutely.
And I think that traders of all experience levels have to watch for themselves, and they have to watch for the fact that when we have a trade on and it's going our way, we may be thinking that this trade is going to continue to go in that direction, but our brains may actually be discounting or just letting go of information that may be telling us the opposite is true. That's why it's so difficult to trade with emotion. We're going to trade with plan and intuition. Impulse and emotion is your worst enemy, especially when it comes to risk management. The next page we're on here is just talking about trade size. And of course, everybody knows the number of contracts traded relates to the overall risk in any given trade, right?
Mm-hmm.
So,
Absolutely.
so when we see traders coming into this and finding some degree of success, we suggest that they trade small, even smaller than they are allowed to, because we really want to learn to crawl before we can walk, before we can run, before we can fly. Adding position size as you are proving effectiveness, or if your strategy, your process is wrong and it's continuing to pay you over time, you're building your account. I think that the biggest jump in risk that a trader should make is going from one contract to two contract, because it automatically doubles the risk. It's going to be more difficult to make the hard trading decision that you were able to make trading one than it is two. Now, there's also position sizing that is directly related to your trade plan. What's the maximum you're allowed to risk on a trade? Well, if your maximum is, let's say $400 in a risk in a crude trade, and you've got a cheap trade that's only risking 8 ticks, well, if your max on that max risk on any given trade is 400, you can actually add another contract to that and stick to your max risk because of the close proximity to the point of failure for that trade. Trade sizing is not only related to your ability to trade it, it's also related to the total amount of risk for the trade altogether. Does that make sense, Dan?
It does, John.
I've been talking so much, I'm not sure what makes sense. But it's, a trade sizing, especially if you're capable of trading multiples. If you're real close to your risk, you can trade a little bit bigger. One caveat to that: volatility. Volatility, you should be reducing the number of contracts you are trading, because the risk is going to be greater on any trade you take. The reward is going to be greater on any trade you take. But if you're over leveraging in volatile periods, you're going to get stopped out quite a lot. It's going to be a rough time for you.
I could not agree more. And just something for perspective here. Our job is to grow these accounts, as I was just saying a moment ago. And I really, really cannot stress enough. When John says going from 1 to 2 is one of the biggest things he'll do, that without a doubt, that's the only time you're truly going to double the risk you're putting on in every trade or in your trades. That's a massive psychological thing to start to overcome. When you go from 1 to 2, you got used to, say, trading crude oil, and you were risking maybe 10 or 15 ticks a trade, and so you're between $100 and $150. All of a sudden, you put 2 contracts on, and that 100 to 150 becomes 2 to 300. That's a huge adjustment. And when you are making these changes, the second you get uncomfortable, the second you can't handle that heat against, that's totally okay. Some traders are just going to be more successful trading ones and maybe twos. Maybe sometimes they'll be able to get to that 4 or 5, 10 or 15 lot. But I can tell you, the second it starts to go against, do not hesitate to bring it back to 1, get back on track, because a small profitable trade, trading 1 lots, is always going to be better than a losing trade, trading 2s, 3s, 4s, and 5s.
Oh, yes, yes. Reducing trade size during known drawdowns, also vital. I got to tell you the story. I was a 1 lot trader in the S&Ps. I'm standing down in the middle of the pit. I got my hand up. I'm offering a 1 lot at some price, and a broker across the pit looks at me and says, buy 5, and turns around. So he just bought 5 contracts. I was trying to trade 1. I had never traded 5 contracts, and these were big S&Ps. This was $500 a handle, so $2,500 a handle trade. I got so scared, my blood ran cold. I couldn't even write down the trade. The market starts going in the direction, in my way, so it's a good trade. Luckily, I had some very friendly locals around me saying, I'll take one. I'll take one. So I was able to peel off 4 of them at scratch, basically. And then I was able to get everything written down, but I was so scared. Adding risk to your strategy does that. It makes it very difficult to make the same difficult decisions.
Absolutely. It's a huge change there. And going on the flip side, when I was with the prop firm, we were trading size, and you got really comfortable trading that size. And when you get to trading your own money and your downsize, you got really used to seeing the dollar value be much greater. And when you downsize contract size, you have to not be comfortable with the big dollars ups and down. You have to manage that expectation no matter what size you're trading.
I can remember that like it happened to me yesterday. Larry Katz was the broker that did that. He says, buy 5 and turns around. I'm like, hey, I only want 1. So, well, too late now.
I'll never forget the day I hit 100 instead of 10 when hedging a position in the bonds. And I didn't notice it right away. And the trade checker looks at me and goes, you just bought 100. I thought you were only supposed to hedge with 10. And OMG, that was the fastest 90 bonds I've ever sold. I think any human beings ever sold in their life. Unfortunately, I got lucky and I made a tick on it.
Oh, nice.
But had I lost a tick, that would not have been good.
Nice. Fat fingers can be an issue. One of the things that is not on this, but we should probably talk about, is if you make a mistake, if you buy too many, if you sell when you meant to buy, best thing to do is just get out right away.
It doesn't matter what the price is.
No, just get out. Don't be an accidental trader.
I've heard too many people say, well, I put it on, I might as well see what happens. And if you have the size and the capital to do that, hey, more power to you. But I don't think most of us have the size and the capital just to slap one on and say, let's see what happens.
Yeah, there was a guy in the S&Ps who was he was off the floor, and he was supposed to buy 2 and he sold 2, or at least he thought he was supposed to buy 2 after he sold 2. So he buys 4. Turns out he was supposed to sell the 2, so he sells 8. So he gets completely flustered, doesn't even know what he's doing, so he buys 16. Figures he's wrong on that one, so he sells 32. he was in such a panic that he had made a mistake. He completely just freaked out, and it's not hard to do.
It's not. It's very easy to get flustered like that. And I will say this, when you start to feel flustered and you don't know exactly what's going on, just stop for a second. Just stop. If you're trading outrights and you can click that just exit cancel all, just do it. It's much easier than trying to do the panic. I've done the panic too many times where you think you filled something, but you don't exactly know, and you're not trading the out. It gets anxiety. I have some balding because of it.
All right. Well, the next item on risk management today is trade frequency. I don't think a lot of folks think of commission as a risk, but if you're an extremely active trader, it's going to increase the cost of trading. If you're a scalper and you are, taking 200, 300, 400 scalps in a day, you're going to incur some pretty big commissions there. And commissions are something that if you aren't an active trader, don't really enter into your mind too much. But I view it as part of the risk of being an active trader or a scalper.
It gets very expensive. Definitely costs of doing this business. When in a business, the idea is to minimize costs as much as possible and maximize profits. So you definitely have to factor that stuff in when you are building out your plan and building out what I think you can call it a business plan.
Absolutely, and those commissions are, of course, directly correlated to the duration that you're in trades. And not only that, part of your risk management as a scalper is you are going to be in competition with some of the algos and the HFTs. Scalpers were a pit term where just guys were standing in the middle of the pit. They didn't even look at charts. They just worked the bid and worked the offer. If they got some bought on the bid, they tried to sell them on the offer. If they couldn't sell them on the offer, they'd hit the bid and look for the next opportunity. I remember trying to learn to scalp, and I'd have one hand up, 40 bid, one hand up, half offer, and I'd get hit on both at the same time. But now with electronic trading, the algos and the HFTs are much faster to the market. They are not emotional. They do not make their own decisions. They do exactly as they're told. And I think if you're trying to scalp in futures, direct just on screen with a mouse, I think you're going to be behind the eight ball. One of the things about being a scalper is, if you're in a losing streak, you may want to stop. You may just not want to reduce frequency. You may want to stop and take a look at what you're doing.
Absolutely. Just to throw this out there to explain how serious this is that John's saying. Recently on our Limit Up podcast, Jack and myself interviewed the former CEO of the NASDAQ, Bob Kryfield, and that's something he talks about pretty heavily in the way the market has changed since he took over right after the tech bubble and to when to the point where we're at now, is how much it has changed, and it's made it so difficult for scalping this day and age.
Yes, and if you are a longer term trader, even a day trader, somebody who is not in direct competition with the algos and the HFTs, they're not going to bother you as much. They don't bother me, but I'm not in trades for seconds. I'm in trades for half hours to hours. So the HFTs just kind of pick at each other and take out stops of short-term traders, and they do a good job of really competing very, very hard with scalpers that are trying to, and there's nothing wrong. I'm sure there's people that can do it. It's just not me. And I think that you're up against some pretty stiff competitors when you are trying to scalp. Trade frequency, particularly in the pit, would be an increase in overall risk. The more you traded, the bigger your opportunities or your chance for an out trade. But trade frequency in electronic trading, if you're a very active trader, you're always in the market. And if something happens, if there's a news event, a headline risk, if something happens and you're in the market and you get a liquidity pocket there, it's certainly going to increase your risk. Back into trade duration, longer time frame charts offer bigger opportunities and bigger risks. You're going to be able to lower the frequency of your trading and your trading costs. And a lot of scalpers are going to be looking at 1 minute charts or very short time frame tick charts. That seems to be the tool of choice for the scalper. But you're going to see some of the same patterns. You're going to see some of the same things in longer term and longer time frame charts. So adding a little more duration to your trades may take you out of that direct competition from the HFTs and the algos. You're going to hopefully be able to recognize bigger opportunities. With those bigger opportunities, maybe somewhat bigger risks, but of course, we're going to manage those risks and trade close to those points of invalidation. The lower frequency, of course, lowers trading costs. Bigger risk and bigger opportunity may require or allow smaller trade size, something that I definitely look into in periods of volatility. If I'm a 3 and 4 lot trader, when in February and March, when the S&Ps got extremely volatile, I was a 1 lot trader. I was well aware that the market was going to move further. It was going to go further against me, against my levels, if I was in something, and I knew I was going to have to risk more. But I also knew that the possible opportunity, the possible profit target, was going to be much greater than in a less volatile environment. So volatility certainly reduce your trade size. And on top of that, the trade duration directly relates to a longer time frame and market state. Trade duration, if you're in a trend, you're going to want a longer trade duration. If you're riding a trend that may happen all day long, the longer you stay in that, the better the possible opportunity. We talked earlier about, hey, profits take care of themselves, especially on trend days. What's one of the best ways we can manage our risk, Dan?
I think it has something to do with using a stop loss.
Yes. We should always use a stop loss.
I think that's the only bullet point you needed. Always use a stop loss.
Always use a stop loss, yes. There's just about every platform allows you the opportunity to pre-place a stop before placing a trade. You can put a static stop there. I don't suggest using static stops. I think markets are dynamic. Your stop should be as dynamic as the stop. You're going to be looking for points past your point of failure to place your stop. Again, market state can certainly change the placement of your stop. Volatile markets, you may need to allow bigger stops in order to keep you in the marketplace. A lot of folks like the idea of using catastrophic stops. In other words, I'm going to put this trade on, but I'm going to put the stop way beyond where I actually would want to get out of this trade, just in case something strange happens. But you don't want to necessarily count on mental or discretionary stops. You put the trade on, you put that stop where the market, where price is telling you to that the trade is now invalid. You get out of that stop. You do not move that stop. You do not change that stop, because using that catastrophic stop allows you the opportunity to say, well, all right, this is where I was going to get out of this trade, but maybe it'll turn around and go my way, and we get right back into that inability to admit that you're wrong, to take the trade off because it is now technically invalid, and then just to move on. Just put your stop in, try not to move it. And now there's a lot of folks that will put the trade on. Just for example, it's in crude oil and they have a 20 tick stop, and maybe they have a 40 tick profit target, which is 2-to-1, which I completely agree with. The market starts to go their way and they start moving their stop closer to their entry point. Eventually they're going to move that stop to entry +1. The market, I don't know how many times and how many people have said this to me. Every time I do that, it seems like the market comes back and rechecks that support level that I got in at, but I've moved my stop there and I get stopped out +1, and then the trade plays without me. If you get a good discretionary support level or resistance level, let the trade play out a little bit. Markets tend to go back and recheck decent levels from time to time. My answer to them saying, what do I do about it, is don't move your stop.
You chose that entry point for a reason. Say it was to get long. If you chose to get long there, why would you get out there? Why would you say, oh, now this trade's invalid and
Right,
I'll take that stop?
right,
Doesn't make sense, right? Because
right.
I think it goes back to what John and I were just saying. You don't get any smarter when you put the trade on. As soon as you get that trade on, you become biased and you start to not be thinking as clearly. Remember, we have these stops here. If it gets to a point where you can't take that risk and handle that stop, then maybe you should not be entering that trade.
It's not invalid yet.
It is not invalid.
Not invalid yet. All right. Risk management starts with each trade. Each trade, you should have an idea of the risk, not a financial decision, not a static decision, a market-based decision. Where does price have to go to prove me wrong? Look for the asymmetric opportunities where the risk is small and the reward is big. Each day requires another degree of risk management each day. In other words, how many times have we talked to traders, Dan, that say, well, I was up 1,000 today and I ended up down 500. That's not good daytime frame risk management. You need to keep a percentage of a profit like that. Let's say you lose half of that. You walk away at $500. It's a lot of money. The last thing you want to do is take that $1,500 swing off your high watermark and end up a loser that day.
Right. Even though you are only incurring net P&L on the day, only incurring a $500 loss, you are seeing $1,500 swing, and that's what takes this toll against us.
Uh-huh. Yeah, it was like the dealer in Vegas Vacation when he says, hey, Griswold, why don't you give me half your money and I'll take you outside and punch you in the face and we'll call it a day, right? So
Exactly.
the layers of risk management go well beyond each trade. You got, each day. If you're having a good day, you want to make sure and preserve a percentage of that. The bigger the day you're having, the smaller percentage of it you're going to risk, but possibly more money you're going to allow yourself to put at risk. But then there's that daily risk, there's that weekly risk. If you're having a bad week, you're having a drawdown, where is your risk management on that? Are you going to hit your daily loss limit every day for a whole week? No, you got to stop the bleeding each month, each year. The name of this game is really to take 2 steps forward, 1 step back. If I would only trade 3 days a week, I could double my income. Really? Why don't you just trade 3 days? I don't know what are the losing days. So you've got to accept the fact that there are going to be losses. You got to keep profits to a certain percentage on a daily basis. You got to try and manage that risk each day, each month, and each year, because if you can't manage money making more is not going to help. How many lottery winners do you hear of that end up broke 2 years later?
Probably a lot.
Poor risk management. So Dan, let's see what kind of questions we have here.
We got a lot, so I'll start going through them here for us and see if we can get through as many as possible.
Bob Rudder. Hey, back to school. I'm looking for Rodney. Hey, I like teachers. You do something wrong, they make you do it again.
Right? Let's see here. We'll just start at the top. Level 2's asking, do you recommend using volatility like an ATR percent deviation VIX to set stops, taking into account structure? John, you got any thoughts on that?
Yes, I do. A lot of traders do like that ATR, or a percentage of the deviation of it, to determine stops. And it is a technical way to do so. I find that using the ATR usually puts stops further away than I'm comfortable with, and quite often further away from the point of invalidation that I'm seeing in the profiles and the charts. So, I'm not saying that it doesn't work, not saying you shouldn't look at it or you shouldn't use it. It just doesn't necessarily look right to me.
Awesome. Yeah, that's a good explanation. I think I know a lot of people do use it. I watch it a little bit, but definitely not something I'm looking directly at for my stops as well. It gives me too much.
Marco, I feel for you. Don't feel too much like garbage. It happens to everybody. I don't know how many accounts I blew up. Keep at it. You can do it.
Absolutely. Jay's got a question here, but I think we touched on that one already, just about how long to hold your profits. We touched on just talking about knowing where you're getting out the second you get into that trade.
Right. And Jay's talking about trades that go in profit, but you hold them too long. It turns out, and then profits are lost. It happens. It probably happens a lot, and it's something to learn from, Jay. Everything we do in profit or loss in trading is an opportunity to learn something. So, where was your intended profit target for that trade? Did it get close to that profit target? At some point, you're going to want to take that trade off, even if it doesn't get all the way to your profit target. Dan, you and I agree on the 10% rule.
Absolutely.
If the trade gets within 10% of my profit target, I can go ahead and take the profit and consider it a full profit target hit. I've had too many trades do just what you're talking about, Jay, but definitely account for how often it happens, account for why your profit target was where it was, and always look back to see if there was something that you may have missed that would have provided a better outcome for that trade. It's all in the accountability of being able to remember the trade, how it felt, what you were looking at, and where the eventual price did end up going.
Absolutely. Jose just asking if Topstep does evaluation of trade plans. Jose, if you sign up for the personal performance coaching, absolutely something that can be done, but not something typical. Tanya's just asking, do you consider it confluence when multiple moving averages line up with each other near a level you have identified? I think that's a simple answer, Tanya. I would have to say absolutely yes.
Yeah.
I think moving averages have actually been something that have really been useful and creative, or I found a lot of opportunity at moving average here, especially in the last 6-8 months is what for sure.
Yeah, Tanya, I would agree with Dan on that. There is a bit of a caveat to that. When multiple moving averages converge without previously being braided together, I find that is an interesting opportunity. But anytime I've seen multiple moving averages braided, in other words, crossing over each other, maybe the market is range bound, those are buzz saws, if you ask me. That's a chop shop. So you have multiple moving averages converging for the first time. I like that idea.
Awesome. Thanks, John. Steve has a question here about moving stops. I think we cover this one pretty heavily. John and I both agree, leave those stops right where they're at. Peter then just asked if we could talk about risk management once the trade is on. I will give my opinion here. I think the risk management should already be done before putting that trade on. Once that trade's on, you should know exactly where you're getting out and how, if you're going to take the loss, where your stop is, if you're going to take a profit, where your profit is, and keep it as simple as that.
Yeah, and Peter, if you're talking more about trade management, trades going your way, do you trail your stop? Trailing stops to me has always been an art form that has been very elusive. Once in a while, you may get some usage out of a tool called the parabolic stop and reverse. It's the parabolic SAR. Watch it in different time frames. Look at how it responds in your time frame in the past. Anytime we want to learn something, we look to the left, put the parabolic SAR, look at it in different time frames, and then watch in a directional move, in a strong directional move, you can keep a shorter time frame parabolic SAR. And a not so strong directional move, you're probably gonna have some bigger stops from that parabolic SAR. So it's a again an art form, again one that I don't know many people who have mastered. People tend to put their stops too close when trailing stops, because the market just seems to have a knack to go and get them. So take a look at the parabolic SAR in different time frames. Whatever time frame you're taking your trades on, take a look at the parabolic SAR in different time frames and see which time frame seems to work to keep you in the trade the longest, in other words.
Awesome. Thanks, John. I think I got, well, here we go. Really quick. Let's see. Cyrus just asking, can you explain a little more about 2-to-1 ratio of making a trade? Cyrus, definitely. So when you're entering into a trade, if your reward is not going to be at least twice what your risk is, it's going to make things a little bit difficult. And here, for perspective, just percentages. I think a lot of traders come into this and say, I want my winning percentage to be 65 or 70%. And that becomes really difficult. Those are huge numbers that not even every professional trader are making. I would say the odds are that chances are every trade you take over time, you're going to be around that 50%. You're going to have periods where you're up to 70. You can have periods where you're down in the 30% range. If you can keep your risk as close to that 2-to-1 or better, you have that 33% chance of being profitable in this industry. And that's really what this is about. It's how can I be successful over time? Because there are times when we're not going to be right even 50% of the time. So if we can set up our risk to reward to make us profitable, even if we're right as little as 33, 35% of the time, we have a chance to continue to stay successful at this. So making sure when you're entering into that trade, your risk is, you're near that point of invalidation and you see a profit that is at least twice what that risk would be for that trade. Varsha, yes, these are being recorded. We'll get them out there as soon as possible. They'll also be on our YouTube page probably by tomorrow. All right, John, do we got time for at least one more here?
Sure.
Let's see here. Do you have a specific question you got here?
James Marche couldn't hear us.
Oh, I'm sorry to hear that. Hopefully
Melcher.
everything's all right. You got
Yeah.
your speakers working there.
Yeah, Steve Melcher is asking, how do you judge volatility? Well, in the equities, a good gauge of that is the VIX. As far as other volatility, you can watch that ATR, ATR, the average true range, that can be also be a pretty decent um, tool to gauge volatility.
Yeah, I think using those two things, you're definitely going to see the volatility. And I'll tell you what, you can probably just look if markets are showing any signs of volatility, you'd be able to find it pretty much on any news channel, on Twitter. Everyone uses that term very quickly when volatility starts to spike. Awesome.
All right. So yeah, a level 2 asking 33.94 break, got out short on the live account. Ask Goog why I chose 33.94. Isn't that the all-time high in the September contract? That's what I'm thinking it is. All right, Dan, everybody, thank you all for joining us. Hopefully you found something useful here. Dan, how about you? Did you find something useful?
I think so.
All
This was a
right.
lot of fun, everybody. Thanks for tuning in.
Yeah. Hey, we'll see you all next Wednesday for episode 3.